Hello. Good evening. Okay, good evening again. Thank you. Thanks, good evening, welcome. It's great to see so many people out here. I'm Ted Bavard, one of the founding partners.
And I'm Mike Blehar, one of the founding partners. We're here to welcome you here tonight. Let me do the click. There we go, there's us. I used to wear glasses, see that? Welcome everybody to the 27th time that we've done this. Every year it gets bigger, and the reason it gets bigger every year is really simple. All of you keep sending us more clients, okay? Thank you.
Thank you.
You keep sending us friends, family, coworkers. We really appreciate it. I'm guessing that next year it'll probably be the biggest one ever.
Like this year?
Yeah, like this year.
Right.
It's all you.
Oh, it's me now?
Yes,
okay.
you,
All right.
you do it.
For those of you who are confused, this isn't the Florida event. I know usually we schedule this when we have minus 12 degrees, the worst, or an ice storm or something like that. We said this year, let's drum up 60-degree, sunny in the afternoon weather. So you can feel what it's like, well, to almost be in Florida.
Yeah.
So here's our program for tonight. By popular demand, we bring Bill Engel back. When I say popular demand, his parents voted unanimously to have him come up again. So he's going to MC us and take us through the program tonight.
But before we turn things over to Bill, we do want to make a recognition, okay? And the recognition we want to make is, you know, for the last 15 plus years, when you have come into the office to visit us, you've been greeted by this wonderful, warm, friendly person, and that person also is that person that you've heard on the other end of the phone as you've called in. And this is a tough one because we got to be happy for her, but we're also sad that Robin McMillan is going to be retiring in March.
Yeah. So it would be 16 years in April if she made it that far. We'll have to talk about that. But I'm looking to see if I see her out there. She was not game for coming up on stage.
Where's she?
But
Where is she?
Far right? Wait. Oh, okay. Wait a minute. Where? Far right. Hold.
Over here.
Oh, there she is. Robin. Robin, we can't thank you enough for all that you've done and all that you've meant to all of these folks who have got the chance to meet you and all of the folks in our office who come to you for all kinds of advice and help, and you're just always such a warm, receptive, just great person. So we will miss you. But you have a couple months to call her, pester her, congratulate her and wish her well until she's retired.
Yeah, that's going to be a bummer.
Yeah, it's going to be tough.
That's going to be a bummer. We're going to miss Robin.
Yep.
All right, well, I think you've heard enough from the two of us. Everybody's like, geez, I hope they don't talk too long. So we're going to turn it over to Bill. Thanks, everybody.
Thanks.
Thank you.
Good evening, everybody. Great to see everybody here. Thanks so much for coming out. Congratulations, Robin. We are going to miss her terribly. So yes, I have the pleasure and the privilege to present the program. That's a lot of P's in a row this evening. But before we start with that, I am going to we're going to show a video of our latest capabilities.
Here's what we offer you.
Here's what we offer you.
Here's what we offer you.
You at Fort Pitt Capital Group.
We offer the feel of a boutique firm with a breadth of resources, like in-house investment management using a personal, holistic approach to financial planning, wealth management, business consultation, and 401k planning through services like
financial planning,
It starts with an intimate understanding of your goals, priorities, and tolerance for risk. We take the time to understand you and develop a plan that fits.
Retirement income planning. Because when you take that last official paycheck, our goal is to make sure that the assets you have accumulated will continue to provide the regular income you need.
Education savings plans. Paying for college is among the largest investments that most families face. We can help you navigate 529 savings plans, covered LESAs, custodial accounts, and trusts.
Here's what we help you with at Fort Pitt Capital Group.
Legacy planning. We have multidimensional planning conversations which can lead to discussing a legacy that will impact who and what is most important to you.
Life insurance. By discussing how it fits into your larger financial plan, we can point you in the right direction so you can make informed decisions with your advisor by your side.
Estate planning. We address complicated estate planning questions directly with your legal counsel, creating a coordinated effort focused on your unique needs.
Mortgages and lending. Through our bank partners, we can offer mortgage and lending options for your home and business needs.
Medical insurance. One of the most confusing aspects of retirement is figuring out healthcare. We can help you choose a broker, then work with them to evaluate your options.
Tax planning. We bring together expertise on your behalf, working with your accountant to make the most tax-efficient financial strategy.
Extended care. Helping you navigate potential life events includes exploring ways to protect your assets. We can provide support and guidance to put your mind at ease.
For more information, visit Fort Pitt Capital.
FortPittCapital.com.
Pretty cool, huh? So I'm just going to run through the agenda for the evening, the program. First, we're going to start with the state of the fort. Then we're going to discuss the 22 market recap. Then the 2023 market outlook. We're going to discuss the Secure Act 2.0, new legislation. We're going to have a brief question and answer session, and then just enjoy the dinner and the party. So the state of the fort. In 2022, Dan and myself became part of the partner group. Ted won the holiday party ping pong tournament for the second year in a row. And our extended family grew. So we had 4 marriages and 3 Fort Pitt babies. On the business side, we achieved our organic assets under management growth goal of 5%. We had 238,000 equity, bond, and mutual fund trades. We were featured in 98 pieces of media. We completed 1,001 financial plans. We took on 24 new 401k plans. We had 8 team members that earned promotions. We added 12 new hires. So a big year for us. A couple of items of business before we go on with the program here. So the first is parking. If you parked in the hotel parking lot, on your way out this evening, please stop by one of the tables and pick up the validation sticker. You'll go down to the parking garage, put the ticket that you got in the machine, followed by that chaser ticket, and you'll be all squared away. If you have any questions, you can ask any of the folks at the tables out there. Next is the giveaway for the year. So we're very excited. It's a stunning and beautiful collapsible cooler bag with the Fort Pitt Capital logo on it. You can carry around your hot casseroles, your cold beverages, or anything else that you want to stylishly tote around. Make all your friends jealous. Now, if you look around, you'll notice that this is as Mike and Ted said, this is an enormous crowd. We had, I think, 500 RSVPs for this evening. So we have enough of these giveaways for 1 per household. One's all you really need anyway. So we just want to make sure that everybody can get one. So if you're a couple, please just grab one on the way out so that everybody gets one. and enjoy those. Okay, I'm now going to introduce our panel of speakers, starting with Dan I, Chief Investment Officer for Fort Pitt Capital Group. Dan joined the firm in 2019, and he's been our CIO since 2021. Prior to joining Fort Pitt Capital, he was the Chief Investment Officer at Roof Advisors since 2014. And also on the panel are Beth Lynch, Senior Advisor, and Jay Somariva, Head of Asset Management. But Dan, take it away.
Thank you, Bill. All right, hello everyone. Hopefully my microphone is working here. It sounds like it is, so welcome. It's nice to be with everybody. I figured we would get started with our report card for 2022 in terms of our projections for the year versus how things actually played out. And, we were fairly, I'd say, sober about our expectations for returns in 2022. We projected an 8% decline for the S&P 500 index for the year. That proved to be too optimistic. The broad market was actually down a bit more than 18% for the year, which actually represents the worst outcome for the broad market since 2008. So I thought we'd just talk about some of the things that we got right and some of the things that we missed. So first, we forecasted that S&P 500 companies would grow their earnings at 10%. We only got about 5 or 6% earnings growth. Inflation also proved to be stickier than we had expected or anticipated. We did see a peak in inflation last year, but it came a bit later in the year than we had expected. And then really the big one was that the Federal Reserve was much more aggressive in raising interest rates in order to combat inflation than we expected. And if we look back to the Fed's own projections at this time last year, they anticipated that they would end the year with short-term interest rates around 1%. And as we all know, we closed with short-term interest rates at 4.5%. So they were much more aggressive than even their own early year forecasts. But we did call 2022 a reset year. We thought that markets just needed some time to correct some of the dislocations that had built up after, let's call it a decade of near zero interest rates and after $8 trillion of stimulus and quantitative easing that represented policymakers' response to the pandemic. So I think we were certainly, spot on our call for a reset year. But I think the real positive and kind of the theme of the presentation is that, we did a lot of the work and we did a lot of the heavy lifting last year to, again, correct these distortions. And that's a big positive going forward. So I want to talk about, some of the resets that we've kind of worked our way through, or at least partially worked our way through. So this chart shows how aggressively interest rates increased in a very short period of time. So if you look at the left-hand side of the chart, we can see that short-term interest rates or short-term bond yields exploded higher from 0% to end the year at about 4.5%. The yield on a 10-year Treasury bond increased from 1.5% to 3.9%. in 12 months. That's a 160% increase in a very short period of time. And this rapid rise in interest rates was really a headwind, not only to just stocks and bonds, but every investment asset class. But again, the silver lining here is after this adjustment is done, it's done, and we don't need to do it again. And we think that with interest rates now close to the highest level in a decade, a lot of this work and heavy lifting is again behind us. So, markets had to continuously, readjust and recalibrate throughout the year to a Federal Reserve that was not only raising interest rates aggressively, but continued to ratchet up their forecasts for future interest rates. But we end the year with short-term interest rates at about 90% of what the Fed has signaled to investors is their terminal rate or their ending point or when they pause their interest rate hiking cycle. And at this point, we don't think that they need to move the goalposts any further, right? We don't think they need to increase their projections for their terminal rate. So this is another area where we think most of the pain associated with the interest rate hiking process is behind us. If we all remember our bond math, I want to spend some time on fixed income because it's important. If we remember our bond math, as interest rates rise, bond prices fall. And as I've already outlined, interest rates rose a lot in 2022, and correspondingly, bond prices fell a lot. In fact, 2022 will go down in history as the worst year in recorded history for a wide range of bond market indices, which we show here on our slide. But the silver lining there is that after these significant declines in bond prices, the bonds that we're buying today, the fixed income investments that we're making today have much more attractive, yields. We're looking at 4.5%, 5% yields on high quality, short maturity corporate bonds with the backdrop of falling inflation. It looks like the best setup that we've seen in a decade. And we think it's going to add, a boost to diversified portfolio returns going forward. Okay, really the same picture with equity market valuations. We started 2022 with stocks at the most expensive, the highest valuation since the late 90s and early 2000s. But after the correction that we saw last year, equity market valuations are now down to long-term 25-year averages. We wouldn't make the case at this point that stocks are necessarily pound the table cheap, but much more reasonably valued than at this point last year. And we think, again, that's a big benefit and a long-term positive for portfolios. All right, I want to spend some time on inflation. That's really been the root cause of the market, turmoil and stress for the past 14 to 16 months. And we can't say that we've seen, a definitive, complete reset on the inflation front, but we can say that we have seen a definitive peak in inflation. That was in June, and since then we've seen 6 consecutive months of declining inflation levels. So we are headed in the right direction. We think that trend not only continues, but picks up some steam in early 2023. And in fact, if we look at the most recent inflation reading of 6.5%, we think that's a bit overstated based on some of the more real-time data that we look at, and we'll talk about that in a little bit of detail. Okay, so we did this last year too. I wanted to spend some time on kind of some of the components of the inflation calculation. As we all know, supply chains have been a big issue for the last year and a half, 2 years. But the data that we look at, the supply chain, stress monitors, and the companies that we talk to are all telling us the same thing, that supply chains are being unclogged and are very close to being back to normal pre-pandemic levels. If we all think back to the first half of last year, the spike in energy prices was a big problem and a big challenge. If we remember, the oil prices spiked to $125 a barrel. Gasoline prices moved above $5 a gallon. But that's really reversed course. Now oil prices are back down below where we were before Russia invaded Ukraine. Gas prices at the national level are down to, $3.20 a gallon. Not saying that's great, but we are moving in the right direction. And natural gas prices are off about 60% from their peak about 5 or 6 months ago. So, a positive development there. The spike in used car prices got a lot of attention from 2021 to 2022. Nobody could get a new car. The auto manufacturers couldn't find the semiconductors, and consumers bid up the price of used cars. But that has also reversed course, with the used car prices down about 16% compared to where we were in January of last year. And looking at a chart, it's pretty clear that we probably have more to go on the downside there as well. All right, this is one of my favorite charts here. This shows the change in the money supply and just the massive peak during what I'm labeling the COVID quantitative easing and stimulus bonanza. And what this shows us is, at the peak, the money supply increased by more than 25% year over year. So what does that mean? That means that 25% of every dollar in circulation was created in this very short 12 to 16 month time frame. And this chart goes back 45 years, and we can see it's pretty clear that there's no other time period that even rivals this spike. So I think it goes without saying that this was or at least one of the main, contributors to our inflation problem today. But, if we look to the right-hand side of the chart, it's easy to see that is rolling over aggressively. In fact, it's in negative territory. The money supply is actually contracting, and this is going to be one of the factors that helps to solve and mitigate the inflation issue going forward. So I've talked about a lot of the positives on the inflation front, but we all know it's still an issue. So what's the problem? Well, there still is one problem, and it's a big problem, at least on paper, and it's the housing/shelter or rents component of inflation, and it's not a small component. It's the biggest. It's either a third to 40% of the total inflation calculation, depending on how you want to look at it. And not only is that part high, but it's one that hasn't rolled over. It's one that continues to increase month over month over month. We think that is misleading. And we think it's misleading because this is lagged, backward-looking, and stale data. This includes rental increases from 12 up to 14 months ago, when housing prices and real estate prices in general were still skyrocketing higher. That's not happening anymore. In fact, the housing market is rolling over hard. 7% mortgage rates are certainly having the Fed's desired effect in the housing market. So nationally, home prices are 8 to 10% off the peak. In some of the previously really hot markets out on the West Coast, those are down, in some areas, 20, 25, 30%. So if we look at more, real-time data from sources like a Zillow.com or a Redfin, they're telling us that today, monthly leases, those prices have been down for the last 3 months. So another factor here is that we're seeing the largest amount of supply come to the multifamily sector, so apartments and condos, since the 1970s. So that's certainly going to help with lowering, rental prices. So we do think that, again, the biggest part of inflation is overstated, which means that the entire inflation calculation is a bit overstated as well. And we think that this, is more evident as we roll into the back half of the year, as some of that backward-looking stale data works its way out of the calculations. So again, we do think that it's a big positive that we're making progress on the biggest problem that we've had to deal with for the past 16 months or so. But the economy's slowing as well. So we enter the year with The general consensus for economic growth or GDP, this GDP growth this year is 0.3%. And that's kind of economist language for, hey, it's 50-50 toss-up if we have a recession this year. We enter the year with, economists assigning the highest probability of a recession in the last 45 years. So I wanted to spend a little bit of time on that. I think if we looked at the recession question, there are really two main narratives. The negative one being, we've raised interest rates a lot in a short period of time, and we haven't felt the full impacts of that through the economy yet, but it's coming and it's going to cause a recession. Whereas the more positive narrative is, we're making progress on inflation, and the job market is still incredibly strong and tight, which allows the consumer to continue to spend, and we're not going to have a recession. So we don't have the hard and fast answer there. But what we do know is that all recessions are different, right? We take a look at all the previous recessions over the last 100 years on our graph here. Some are very deep, meaning that we see a large contraction in economic activity and GDP and last a long time. And those are big dots on the graph, as you can imagine. And some are very short and shallow, which we show with the little dots here. So our view is that, if we do see a recessionary environment this year, it's likely to be of the short and shallow variety. And we feel like that for a number of reasons. First, when we look at the banking sector, this is not 2008 and 2009 where, the banks were completely, undercapitalized, they were over-leveraged, they were loaded up with toxic assets, and the banks were really the source of the systemic risk in the system. Much different picture today. Banks are extremely well capitalized, which we show on our chart here with capital ratios, the higher the better. And banks have been very cautious and prudent with their lending practices as well. So we think that banks are going to be able to continue to lend to the economy, continue to extend credit to the economy, even if we do see an economic downturn. Really the same picture with households and with the consumer. So here we take a look at household debt in relation to GDP. So the lower the number, the better, the more conservative, the less leveraged. And we can see that consumers just aren't overextended like they were, in the run-up to 08 and 09. Consumers also have, a massive $1 trillion in excess savings. So this is down from, the peak of $2 trillion, and this won't last forever, but we do think that this excess savings from, the pandemic stimulus and just the disruptions in spending patterns during that time period, we do think that this helps and cushions, if there is an economic decline. And then the most important mitigating factor is, as I mentioned, the job market is extremely strong. In this country, we still have around 10.5 million job openings. And if you look at that per worker, we have 1.7 job openings for every available worker. We've listened to companies for the last 2 years tell us that their biggest problem, their biggest challenge is finding, qualified workers. So we are seeing, the headlines about hiring freezes and layoffs. And we think that, on the margin, that is going to continue, and the unemployment rate will rise from very low levels. But we don't think that we're going to see the massive, across-the-board, deep job cuts that we've seen in deep recessions, because companies know how difficult it will be to bring workers back into the labor force. Okay, so again, we recognize that we do have an elevated level of risk for a recession. If we see one of those, we don't think it will be deep and long lasting. And I think we should look also look back at history and what history tells us that on average, stocks tend to decline 30% during or before a recession. Well, stocks were down 27% for the year in late October. So I think it's a fair point that, hey, we've priced in a significant amount of that already. We've already done a lot of that work. But we think this is going to be the big challenge for the first half of the year. As I already mentioned, and as we show on our graph here in blue, expectations for GDP growth this year are hovering right around zero. Nobody expects, a robust economic growth environment for 2023. But at the same time, we do have a bit of a disconnect between expectations for economic growth and corporate earnings growth. The consensus is still that corporate earnings or corporations or S&P 500 companies are going to be able to grow their earnings at about 5%. Difficult feat if we do have the situation of flat to negative economic growth. It's going to be a challenge for companies to grow their earnings at a pretty healthy mid-single digit clip. So we think the first half of the year, as I'll talk about in a little bit more detail, is all about grappling with coming to the likely conclusion that earnings expectations for this year are a bit too high and need to be adjusted to economic reality. So let me start wrapping up with our 2023 outlook, and a little bit different twist this year because we do anticipate a bit of a bifurcated type of environment between the first and the second half of the year. So for the first half, I think we need to we expect markets to struggle a bit, this difficult, challenging environment to last a bit longer as the market grapples with the impact of much higher interest rates, slowing GDP, rising unemployment, et cetera. So if we were to base our forecast just on what we expect for 2023, we expect S&P 500 earnings to decline by about 5% for the year. If we were to use an 18 price to earnings ratio or multiple or valuation, that gets us to 37.80, which is down about 2% from where we closed 2022. Not very exciting, I admit, but we're only giving that about a half weight because we expect a different environment in the back half of the year, and I think that's where I get more encouraged. I think we certainly could see an outcome where some of these headwinds that we've been dealing with for a long time turn into tailwinds. And what do I mean by that? I mean, by the second half of the year, we'd expect the Federal Reserve to be done with their interest rate hiking program and to be on the sidelines instead of being in investors' face every day telling them how aggressive they're going to be with their interest rate hikes. We'd also expect it to be a situation where it's pretty clear to investors and to the market that inflation is heading back towards long-term trend levels. So, it's a bit too far out to make a broad or really precise estimate for 2024, but we would expect at this point a more normalized environment where corporate earnings return to growth. And I think by the fall of this year, investors in the market are not going to be pricing stocks based on this year's earnings. They're going to be looking out towards 2024 earnings, and we expect a better environment at that point. So we're using $230 in earnings per share for 24, giving that a 19 PE multiple, and that gets us to a price target of $43.70, which would be a 14% return from 2022. And again, we're going to weight that by 50%. So take half of 3780, we take half of 4,370, and our 2023 price target for the S&P 500 is 4,075. That works out to about a 6% in price appreciation, then we have another 1.5% or 2% in dividend yield on top of that. So really a call for more normalized type of return environment and some catch up for this year. And then finally, I'll just kind of close with my main point is that we had a lot of distortions coming into 2022. And what do I mean by that? Interest rates were too low, equity market valuations were high, inflation was too high, there's too much liquidity in the market, probably had too much speculative froth after such a positive 2021. But we've done a lot of the work, and we've done a lot of the heavy lifting to really normalize those distortions. And we view that as a big positive for the long term. We feel like we have a much better, foundation, much better long-term fundamentals today than we did back in 2021. So we think there are, even after a difficult year last year, some really strong positives to take away. So with that, let me turn it back to Bill here.
Thanks, Dan. Appreciate that. A lot of great information and hopefully a little bit more good news than last year. All right, so I'm going to introduce our next speaker, Beth Lynch, Senior Advisor. Beth is, I think, celebrating right now her 5th anniversary with the firm. And she's one of the thought leaders and subject matter experts at the firm, particularly in some of the more technical aspects of financial planning. So she's going to speak about the latest legislation known as Secure Act 2.0. Thanks, Beth.
Wonderful. Thank you, guys. It's official. Secure 2.0 is law. How exciting. We've been talking about it. We've been anticipating it. We had concerns about whether it was going to pass or not, and it was signed into law, of course, right at the end of the year, December 29th of 2022. This is part of a larger bill, the Secure 2.0, and it is setting us up for some really positives. So if anybody remembers Secure Act that got passed in 2019, it was exciting that we went from the required minimum distribution date, your beginning date that you had to take required minimum distributions, from 70.5 to 72, but it also eliminated the stretch, or the stretch IRA. So there were some positives and negatives in the first Secure Act. Secure 2.0 covers numerous changes to retirement provisions. It's designed to increase retirement savings, facilitate access to retirement savings, and to encourage employees to save additional dollars. It's also there to help lower employers' cost of offering and funding retirement savings plans. So a lot of these provisions are going into effect 2024 and later, but let's talk about some of them that are happening for 2023 and a few others. We're going to do high level look at all of the things that I think are going to affect most of the people in this room. So I know that I've had many discussions with my clients about the ones that we're going to turn 72 in 2023. And we talked about cash flow and tax planning for this big required minimum distribution that they were going to have to take this year. That's now off the table, right? So I used to send out a milestones birthday email to anyone turning required minimum distribution day age every January. I don't have to send that email. There's no one new getting the required minimum distribution this year. So what's happened? If you were born in 1950 or before, you're staying the same. 72 last year, you had to take your required minimum distribution. You will continue to take that required minimum distribution. No changes for you. Those born in 1951 to 1959, your required minimum distribution is going to go up to age 73. This is a great opportunity for those who have not done some Roth conversions or were going to have to, or thought that they had to take a required minimum distribution to do some tax planning. You have a few extra years to do those things. Born 1959 or later, you get to wait to age 75 to take your required minimum distribution. This is going to let your IRAs, your 401ks, your Roths, your individual accounts, whatever, it's all going to grow for you. So you get a couple extra years. You'll notice that there are overlapping years, 1959 on both of those. That was an oversight. there was an error in the report originally, and 1960 will actually be the new for the 75. So that's been changed just recently. We just got information on that. So it will be 1960. So, and there's no impact on QCDs. So anyone who does their qualified charitable distributions at 70.5, that is staying. That has not been moved up to the required minimum dates that are listed here. Tax penalty reduction for RMDs that are not taken. Hopefully that has not occurred here. Hopefully all of your advisors are getting your required minimum distributions out on time, and you are not receiving an excess penalty. It was hefty. Prior to this year, if you missed your required minimum distribution, the amount that you did not take was assessed a 50% excise tax. That is being reduced down to 25%. It's still a large number. However, if you do it within the tax window, the correction window, they'll reduce that down to about 10%. So you have to fix that. Just don't miss them. Your catch-up IRA contributions, effective next year, 2024. These are finally going to be indexed for inflation in $100 increments. Prior, they were just increased every few years, and it was usually in $500 increments. That's going to be changed. There's also going to be an increase in your 401k catch-ups. I think this is really exciting. This is a great opportunity for individuals to save more inside of their 401ks. So starting in 2025, it's going to be applicable to anyone who is age 60 through 63 during the year. You can increase your catch-up contribution by more than that regular age 50 and over. So what will happen is you will be able to contribute the greater of $10,000 or 150% of the standard catch-up contribution for 2024. So many of you are thinking, wait a second, if I think about that, the catch-up for 2023 is $7,500. And if it's 150%, that's $11,250. It's government math. They'll increase that $10,000, so don't worry about it. The other thing I want to note is for simple IRAs, that limit is $5,000. That 150% is still there, but for simple IRAs, there is a different number for the catch-up. Okay. Oops, I went the wrong way. Okay, so here's an exciting one, Rothification. I don't know how many people have heard about this. However, so this is going to happen for any employee who has earned greater than $145,000 in 2023. Your catch-up contributions that you're going to give into your 401k have to go into after-tax or Roth accounts inside of the 401ks. So and this is for non-simple IRAs. Again, this is 401ks, 403bs, 457 plans. This is going to add a Roth option to a lot of 401k plans that have not been there. So there's going to be a lot of great opportunity for individuals to save after-tax money and have those catch-up contributions go into an after-tax. QCDs, qualified charitable distributions. I mentioned this earlier, this is not changing. You can still do these at age 70.5 and older. What they are, if you don't know, is you have an opportunity to take out up to $100,000 out of your IRAs and give those to charity completely tax-free, as long as it goes directly from your IRA to the charity. It counts towards your required minimum distribution when you get there at 72, 73, and 75. But this year, you're going to be able to also give $50,000 to what's called a, forgive me for that, the ability to fund a split interest entity, such as a charitable remainder trust, a charitable remainder annuity, or a charitable gift annuity. That limit is $50,000, but this is a one-time deal. And it can only happen this year, but it does count towards that 100,000. So again, it's a great way to get money into these charitable accounts that you were not able to do prior. The other thing that's going to happen with Secure 2.0 is that this will be indexed for inflation, the 100,000 that you're going to do for QCDs. Again, that will be in 2024. Okay, this I think is a really big one. A lot of individuals we talk to fund their children's 5 to 9 plans, and they're worried that they're going to overfund it. Here's an opportunity to fund a 5 to 9 plan, and there's going to be an opportunity for that beneficiary to take out $35,000 out of those 5 to 9 plans and be able to roll it over directly into a Roth IRA. So this is completely new. There are some caveats to it. The big one is it must move directly from the 529 plan to the Roth. The second is it must have been open for more than 15 years. So parents, grandparents, start early, front load it if possible, because any contributions to the 529 plan within the last 5 years of doing the rollover and the earnings on those contributions are ineligible to move to the Roth. So the limit I said is $35,000. Next caveat, in order for that beneficiary, that account owner of that 529 plan to move it into a Roth for themselves, they do need to have earned income. And then at that point, they can only do the lesser of their earnings or the contribution for that year. So for example, if you have a student who is out of college, they still have their 529 plan, they earned $5,000 the previous year or this year, they are able to take $5,000 from the 529 plan and roll it directly over to a Roth IRA. No taxes, no penalty. The limit, though, is $6,500 if you were doing a contribution. So if that student did not have at least $6,500, they can't roll that $6,500. They can only do up to their earnings. And so there's a lifetime rollover of about $35,000 on that. So just keep in mind. So it will take a few years to get those in there because of the contribution limits. Last but not least, of course, there's many other things that are in the Secure Act 2.0, but the big one that a lot of people aren't aware of is the elimination of the required Roth distribution from your Roth 401ks. For those that don't know, if you keep your 401k plan with your employers after you retire and you hit your required minimum distribution date, you have to take out a required minimum distribution from an IRA, your 401k, and part of that 401k, not only do you have to take it from the traditional part, but you have to take it from the Roth portion. And you're saying, wait, those are after-tax dollars. That was one of the negative rules that were put in place for employer plans. So a lot of people were rolling those out and making sure to get them into the Roth IRAs to keep that tax-free and elimination of doing a required minimum distribution. So that has been taken away, and that will start also in 2024. Thank you so much for your time. I know I was standing between dinner, so I'm going to I'm going to turn it over to Bill, and we're going to do some questions and answers.
Thank you, Beth. Okay, yeah, so it is now going to be Q&A time. There are going to be 3 folks from Fort Pitt Capital, Corey, Daryl, and Miles, milling around with microphones. We want to keep it fairly brief because we are coming up on dinner. If you are, too shy to raise your hand, or if you do raise your hand and we don't get to you, just find your advisor or a Fort Pitt Capital employee after, and we'll be happy to address your question as best we can. So we're going to go ahead and open up to questions. we got one? Okay.
Testing. All right, it's working. Hey, Tom, how you doing?
Good.
Good. Why don't you speak it right into here?
Okay, my question is, what are your plans if there's a default on the debt?
Okay, so the question is, what are the plans if there is a default on the debt? We've got Dan, Beth, and Jay as the panelists here. Jay will handle the more economic and geopolitical questions. So, Jay, maybe that's one for you.
Yeah, that's obviously a question that's probably on everybody's mind, because if you are watching any of the news whatsoever, the politicians on both sides can't wait to get in front of the camera and talk about it. The odds of default, and I mean a real default that you do not get paid on a U.S. Treasury, are slim to none. We have so much ability within the government to actually raise or lower the ceiling without a vote on it, that we're able to manage it within the Treasury. And we have enough in the Treasury right now to manage it probably till the middle of July and August. And nobody wants that, obviously, to happen. It's actually embarrassing that we even talk about it every year, and it's becoming a political football back and forth. But I would not worry about that. I think somebody will come in and save the day as usual, but I think we'll be fine.
Okay, Miles, you have a question?
Yes.
What effects is a cashless society going to have on investments?
So the question is, what effect will a cashless society have on our investments?
Correct.
Okay. Dan, maybe?
Yeah, I don't know if we're going to, I think there's going to be an extreme amount of pushback in that direction. You know, I know there's about a dozen banks right now, quote unquote, testing some type of digital currency. You know, I think that was the outcome. It certainly gives, you know, governments a tremendous amount of control over consumers. So I'm not sure that that's the outcome, or that's the direction that we're gonna end up.
Any other questions over here? Bill, we have one.
Okay, we've got Daryl.
What are the expectations with long-term interest rates? Are they going to stabilize? Are they going to come down in 2 or 3 years? Thanks.
Great question about the long-term interest rates.
I'm assuming that when you talk about long-term interest rates, you're saying 10 years and beyond? Is
Shorter, actually. 2, 3 years.
Oh, so the short-term interest rates. They have come in quite a bit since we started to raise rates earlier or last year. So we've seen them come from, you know, a high of, it depends what you're talking about, but, you know, almost 4.5%, almost close to 5% in some instances. What we're seeing right now is a tug of war between the actual Fed officials and the Fed funds futures markets. So we're trying to figure out where these are gonna ultimately end up. But maybe to answer your question of where you specifically think the rates will be in the 3 to 5 years, I think we've probably stabilized to a point now that we've priced most of the action into the market.
Okay, all the silverware clattering tells me that it's time to adjourn for dinner. Thank you, ladies and gentlemen, for your attention. And again, if you have other questions, please let us know, but enjoy. Thank you.